How to prevent direct debit carnage, this one. Now, way back in the financial crash, back in 2008, 2009, 10, the mortgage sector, if you were in it, just died. And banks just collapsed. There's talk of it happening at the moment. I don't think it's that bad this time, but back then the big boys were nationalised. Nobody was lending any mortgage money. The specialist lenders stopped and just went bankrupt, most of them. The big 5 banks, Nationwide I guess was in there as well, only had limited money to lend, and they were so scared of lending anyway. They were trying to build up their capital, which meant that the mortgage market died a death completely. And my business, as a result, of course, went down as well, and we had lots of costs, young children to pay for, etc. So I often did what I call direct debit research, or a cull of my direct debit. So I went through every expenditure that we had as a business, as a family, and I went through the statements, and if anything on their direct debit I didn't need, or didn't think I'd need, or didn't really know what it was, I would just cancel it. And we call that direct debit carnage. Now, your clients might be doing the same thing, because you advise them on a mortgage, sold them a mortgage, you sold them some protection, some general insurance, home insurance, and maybe some life assurance. You'd have done different companies probably with those, so the direct debits would be called different things. So it might be NatWest, might be the mortgage, it might have been Prudential for the home insurance, it might have been Aviva for the life assurance. So your client will be getting these direct debits out, and we'll go through them, particularly if they've come across some hard times. Now, cost of living, everything's different, of course it is, but you got to think about these things, because people will struggle. And it reminds me of a lovely song from the 1980s. I'll show you the picture of the chap that did the singing on this one. Here's a picture. I don't know if you can pick that one up. The Money's Too Tight to Mention, which is a Simply Red track from 1985. Take a look at the lead singer there. He looks very 80s, doesn't he, with his outfit there. Now, it was a brilliant song. I think it went to #1, not quite sure. But it talked about America in the mid-80s. Somebody had been made unemployed, etc. And this guy wasn't getting unemployment benefit or anything. So it's just to remind you, people will get to the stage where money's too tight to mention, and they will go through the direct debits. Now, what I want to do now is give you 7 tips to help you with this if you're carrying out MOTs with your client, which you should be doing. You should be doing it anyway, because it's the right thing to do to keep in touch with existing clients, because they already know you, love you and trust you, and they'll do business with you if you keep in touch. If you don't, they'll forget you and go on. And besides, things like consumer duty is only cementing the need to do that anyway, because you should be doing it. So 6 ideas. #1 for you. Let's grab a pen for you. And this one's about skiing downhill, as I call it. Here we go. Skiing downhill. If any of you have done ski, I've never skied, but apparently you go downhill when you ski because of gravity. And that's the point here. So what do you want to do when you have your MOT with your client and you're chatting about them, updating them, whatever, just to remind them of the state benefits that are available if they fall upon hard times. So job seekers, welfare benefits, universal credit, get some numbers out, get some figures out, show them what they're going to get if they do fall upon hard times. Now, the point behind that is you're now comparing the state benefits with the benefits that you have given them in your life insurance, income protection, or whatever it is, so that they see like £120 a week from the state, and they see you're able to give them £1,000 a week. You see, it makes them think about, they're actually getting some value for their premium. So I would definitely do that with them when I talk to them. Here's another one which not a lot of mortgage brokers really get, and I understand that because it's done for you. But when it comes to getting commission, what I suggest you do is you go non-indemnity. Now, it's a horrible phrase. You've probably heard of it. Now, non-indemnity versus indemnity is the way that you receive your commission from the insurance company. Now, most of you probably get a lump sum of commission, or your company that you're part of gets the lump sum of commission, and you get a bit of that. And then what happens is if the customer cancels the direct debit within a certain time period, you get that commission clawed back. Because when you do it on an indemnity basis, you're really getting an interest-free loan from the insurance company for the total commission that you will get if the client keeps the policy forever, really. And if the client doesn't, they want their money back. So what we suggest is you think about non-indemnity commission. In other words, getting it each month. So effectively, client pays a premium, you get a tiny percentage of that. Client pays another premium, you get a tiny percentage of that. I know it's not going to fill your coffers, but it means that you're only getting commission for the premiums that are being paid. Now, once you start getting a lot of these, it all adds up. Of course it does. General insurance is usually paid that way, which is why you have things like trail commissions and ongoing commission that's paid forever. And I know some brokers that have done very well out of general insurance commission, only after they've got a critical mass of policies sold. So that's something to think about if you want to preserve your cash flow. It's butter now rather than guns later, or whatever they call it, don't they? So have a think about that one as well. Now the other thing to think about here, this is point number 3. Let's put this one in red for you. Number 3 is some insurance companies offer a lot of flexibility. So if your client is thinking about the premium costs, and it's costing a lot of money, try and think about the flexibility. Maybe the insurance company allows a premium holiday. Some do. Maybe they'll let them off a couple of months of premium if times are really hard, if they've lost their job, for example, and they're trying to get a new job. So maybe 2 or 3 months off the premium might be a useful opportunity. So take a look at the insurance company you're with and see if they offer that, because the insurance companies don't want to lose clients either, so they're not daft. They're working out flexibility as well. On the other one, you can adjust the cover. There you go. Now this is the one that I did actually 10, 11, 12 years ago. I was looking through my insurance, as I said to you, and I was paying £175 a month for my income protection. That's a lot of money, but I'm at an age where it costs a bit more than the average. And I looked at that, well, I can't afford that anymore. I really wanted to cull my expenditure. We had to. Life was like that. So I actually decided to adjust the cover. Now, in my income protection plan, I went from a 3-month deferred to 6-month deferred, and they allowed me to do that. And that cut the premium dramatically. I also cancelled the index linking, which meant that it went up by 5% each year. I stopped that, and that immediately prevented the premium from going up anymore. And I was able to bring the cost down by 40, 50 quid, which made a difference. But I kept the policy. I've still got it now. And I reinstated index linking. I had to have another medical, but it meant that I could cover that period of uncertainty, if you like. So have a think about adjusting the cover. Income protection is pretty useful at adjusting the cover along the way. Let's have a look at thinking about doing half-yearly reviews here. Half-yearly reviews is the next topic for you. Now, I've talked about these before. If you're doing a half-yearly review or yearly review, whatever it is, resell the protection is the key here. Talk about the need for protection, because the client might have forgotten it. Now, remember, when you do this properly, you don't preach. Nobody wants a smart aleck financial advisor, mortgage advisor telling people what to do. Sorry, you don't. It's not the way the world works. You need to coach. You need to facilitate. So re-coach the client on the implications of dying, getting ill, etc. Just go through the motions again. Just remind them of why they took it out. And that's a useful technique to do. Again, under consumer duty, you're going to have to do these sort of things. If you charge a fee, you're going to have to give fair value for your fee. And it just doesn't happen right there and then. The fees, of course, occur as an ongoing fee, therefore you need to give value for that fee as well. When you're conducting your MOT, you use your affordability expertise. And what we do really well is we do good budgeting. We're able to complete budget analysis forms. We're able to do good affordability guidance and chats about income, expenditure, etc. So it's what we're trained to do. So use that technique, that skill, to help the client to deal with if money's too tight to mention. If they really moan about money that's too tight to mention, really go through their income and expenditure and see what they can get rid of without losing any benefits. You're trained to do it. You're an expert in that area. So use that technique as well. The other thing you could do, just to finish things off, do this one in red, is go for classic benefit selling and highlight some of the key benefits they're getting from the policy. Obviously, the money they're getting is a benefit. Of course it is. Compared to the state benefits, it's much better. But what other benefits do they get? Now, have a look at some of the things that might interest them. Child cover, for example. They might have had some children, so they're getting free child cover under their critical illness, could be one. It could be the income protection gives them holiday benefits, maybe repatriation. They might not need for travel insurance. Some of the high bell whistling things give all sorts of benefits, don't they? Some of these high expensive policies that they're doing. Doctor services, online services, many do that now. GP24, I think it's called. Mental health counselling, some of them give as well as part of the deal. So take a look at some of the other benefits and highlight a few of those that the client may never even thought about. So they think, actually, that's really something we do need. Let's not think about cancelling that. Let's cancel the Netflix or the Sky instead, or the season ticket to Gloucester Rugby, which might be another example that you might choose to do. So there's 7 ideas really that will hopefully help you to prevent direct debit carnage. Remember the song Money's Too Tight to Mention from Simply Red. It was based upon the mid-80s in America, and what was happening there, of course, we had a massive recession. Millions in the States and the UK were struggling with unemployment. Was a big issue, of course. Now unemployment's not so bad, but people have mostly got jobs, but salaries are much lower per se compared to the 80s. So people are finding it difficult to cope. 40 years later, as I say, it's the same thing. History always repeats itself. So if you ever find that money's too tight to mention for your clients, have a chat with them about things that might stop direct debit cards. Hope that's been useful for you.